Okay, so we're going to finish up that last section of chapter 12. So page 22 is where you need to be. We kind of went over the terms, right? Some of the terminology and basics on liquidating, right? Wrong?
Yes.
Different?
Yes.
Okay, thank you. All right, so just to recap, liquidating. This is done when a business is closing down. They're not shifting partners around, they're shutting the doors. So that means liquidating means that they're paying the liabilities. Realization is selling the assets, and you'll have a gain or a loss unless you sell them at what you got in them at cost. Okay, so very important for you to remember in this process. And pay attention here, because when we were going through these exercises in the 8 o'clock class, even though I like emphasize, I still got different answers. Okay, so there's steps in this whole process. The first thing we're going to do is sell the assets. That's realization. There normally will be a gain or a loss from that sale of those assets, and we'll have to allocate that to the partners using the income sharing ratio. Grab that. Those are on. That, yep. So remember the gain or loss. Gain or loss is a type of income, so we're going to allocate that using the income sharing ratio. Okay. The third thing they're going to do is pay the liabilities from the cash that they made from selling assets and whatever they already have in the bank. So they'll distribute any cash left over to the partners using their capital account balances. So the gain or loss is using income statement or income sharing ratio. Remaining cash is capital account. Two different ways of doing it. You're not going to use the income sharing ratio for both. But I kept getting that answer in the first class. All right, so a note. When we start getting into these examples, we are using very generic terms just to keep it simple. We will use cash, but for all the other assets, we're just going to call them non-cash assets. So what is a non-cash asset? Anything but cash. Okay? So it's an asset that's not cash. So it's everything else. All right. We'll just use the term liabilities. It can mean, get those problems right there by the fan. By the fan. Mm-hmm. It can mean accounts payable, notes payable, anything payable. They're paying all the liabilities off. So we're just using liabilities. We're trying to keep it simple. We're on page 22. All right, so now we're moving to page 23. I'm going to go through, we're going to go through this in steps. Kind of get you used to the process. So example 1 here, we've got, y'all remember what a post-closing trial balance is? And there's nothing in it but assets, liabilities, and equity because they've closed the books. Okay, so that's what we've got here, except it's just very generic. All right, so this is Wilson and Everett, and they have the following balances after they've closed everything out. $20,000 in cash, $74,000 in other assets, $34,000 of liabilities, and then the two partners each have $30,000 in their capital accounts. All right, so the two partners share their income and losses using a 3-2 ratio. They're giving us the details of our problem here. Non-cash assets are sold for $85,000. So we need to go through the steps of the liquidation as outlined. First thing they're going to do is sell their assets. So what did they tell us the sales price was?
$85,000.
$85,000. Y'all are much more alert too. First class is like, oh my gosh, they're not awake.
Well, it's 8 a.m.
Oh, it's awful. I feel bad for them. But plus the material is often very boring in here. Unless we veer off subject. All right. So what did they tell us was our cost of the assets?
74.
It's $74,000. So what we're trying to determine here is, did we make any money on this sale or did we lose any? We're just selling our assets. They're having a garage sale, selling what they got. Now, this is what they have in it. That's their cost for their book value. They sold them for 85. So what's the difference?
11, what else?
Is it a gain or a loss?
Gain.
It's a gain. Or you can circle gain, whatever. Okay, that's good. We have a gain. Now, remember I told you gain is a type of, it's a form of income. So we need to allocate that to the two partners based on their income sharing ratio. Since it's income, we're going to use the income sharing ratio. It's 3 to 2. 3 plus 2 is 5. So Wilson's share is 3/5. Everett's is 2/5. So I kind of went through the whole explanation. So our gain from part 1 is 11,000. Oh, that's interesting. If you're just in the wrong place with this thing, it thinks you're trying to move it and not write on it. Okay, so if we're allocating this $11,000 gain to the two partners, how much is Wilson going to get? What is that 3/5?
6,600.
So if we calculate, if we take 11,000 times 3/5, we get 6,600. What about for the other one? 2/5 times 11,000.
4,400.
4,400. So we should be able to add these up and get the amount of the gain. If we don't get that total, then we've calculated something wrong. Because we're just trying to take our gain amount and determine who gets what. Okay, so the third step in the process is to pay our liabilities off. And we have cash. If there's any cash left, in the trial balance, we have that. Plus we have what we got from selling the assets. So do we have any cash to begin with on our trial balance?
20,000.
Okay, so we start out with 20,000 on our trial balance. That's up at the top of the problem, up here. We got 20 grand before liquidating. So how much cash did we get when we sold our assets?
11,000.
No, that's your gain.
Oh,
How much money did we get?
85,000.
85,000. Okay. So how much do we have after realization of the sale of the assets? What's our total now? 105. So that's kind of like you buy a car for 10 grand, say, what you have in it is 10 grand. And you turn around and maybe it's more valuable, you got a good deal. So maybe you decide in a couple of weeks you don't want it anymore, you want something else, so you go sell it for 12 grand. You made $2,000. But how much is that person going to give you when they buy that car? $12,000. So that's the gain is the difference between what did you pay for it versus what did you sell it for. But that's not the actual cash you got. Cash you got is going to be the sales price. All right, so how much are our liabilities? 34. So we're going to take that $105,000 of cash that we have now, and out of that, we're going to pay everything we owe. So what do we have left after we pay our bills?
71,000.
All right, so $71,000 in remaining cash. Okay, so we've done those 3 steps. Now let's figure out how that's affecting the partners' capital accounts. Okay, so what did they start out with before all of this?
30,000.
Yeah, they each had 30,000 when they started this process. We sold all the assets and determined they had a gain, and we allocated some to each one of them. So we said Wilson gets 6,600 of the gain. Everett gets 4,400 of the gain. So let's see what they have now. Add those up. Wilson has 36,600, and Everett has 34,400. Okay. So there's where their capital balances sit. How much is each one of them going to get in cash? First of all, what's this plus this? What's 36,600 plus 34,400? So you have 36,600 was 34, 71?
Yeah.
How much cash do we have? 71. So how do you think we need to distribute this? The goal is to end up with zeros. All zeros. We want to zero every account balance out. So how are we going to distribute the remaining cash? What did I tell y'all in the notes?
It's gonna be based on the capital.
It's based on their capital balances because that's their equity. And we want to zero these out. They're getting paid their equity, and ultimately we want to wind up with a zero balance. So if you forget, if you can't remember how this works, the capital account should total up to the amount of the cash left, and we should pay them out based on their cash balance. If we use the income sharing ratio, these numbers would be different, what we distributed, and they'd still have balances in their capital. You know, so we're trying to make it go away. That makes sense? Plus, whatever's in their capital account, that's their investment. So they're getting whatever their investment back. Is that rational? You know, rationalize that? Make sense out of it? Might not be rational, but. Okay, so now we're gonna look at a liquidation where they lost money on selling the assets. See how that looks. All right, so Grayson and Steele, they have the following numbers in their post-closing trial balance. Cash of $24,000, non-cash assets, $54,000, liabilities of $14,000, and each partner has $32,000. They're sharing income and losses on a 2-to-1 ratio. Non-cash assets are sold for $45,000. So there's all our detail. Now we have to apply it to the steps. All right, so our sales price for our assets. What'd they tell us? $45,000. What's my cost of those assets? How much do I have? What's my cost of the assets or my book value?
54.
54. So if I sold them for 45, but they cost me 54, now what?
You have a $9,000 loss.
Yeah, you got clobbered on that a little bit. So I'm putting it in parentheses to show you it's a negative. So we have a loss. All right. So we need to allocate that $9,000 loss to the partners. So Grayson gets 2/3, Steele gets 1/3.
6,000.
This one's easy. I like these like this that are easier to compute. And 3,000? Yeah. Okay, so we should come back to that total gain or loss amount. If you don't, you've calculated something screwy. Okay. So now let's see, let's pay our liabilities and see what kind of cash we have left. So before we started this whole process, we had how much cash? Look on your trial balance. On page 24.
24,000.
We had 24,000. How much did we get from selling our assets?
45,000.
45,000. So now how much cash do we have?
69,000.
$69,000. Okay, so that's what we're going to use to pay off our debts. So how much do we need to pay our debts?
14,000.
So we'll subtract from our cash our debts. And what do we have left after that?
55,000.
All right, so we got $55,000 that we can pay our owners, our partners. Okay. So let's see what the capital looks like in each one of them's account. So each one of them started with 32,000. I mean, and would they both start with the same thing? Probably not, but especially if you don't have an equal income sharing. But again, this is just an exercise to show you how this works. All right, so we calculated 6,000 of the loss goes to Grayson and 3 goes to Steele. So what do they have left after that? Grayson has 26. You're just subtracting it out. And Steele has 29. Okay, so who's getting what kind of cash?
Grayson gets 26,000 and Steele gets 29,000.
Right. So they're going to get cash in the same amount of what their capital balance is, because what you ultimately want to end up with is 0. I'll do that. Okay. All right, so let's look at one other type of situation that you will encounter. What if the whole process leaves one of the partners with a negative balance? What do you do then? All right, so in this one we have Farley, Green, and Hall. And here are their balances before they start this liquidation process. We've got a 5-3-2 ratio. It's making it really fun now. So what would that be? What would that look like? How much allocation each partner? What's the total? 10. So Farley gets 5 out of 10. Green gets 3 out of 10. Hall gets 2 out of 10. And if you're quick with the tenths, it's percentages. You can do percentages. 50%, 30%, 20%. Yes. Okay, I can't hear you. I'm sorry. What about the 5? You can if you want to, but I mean, you don't have to. You don't have to like reduce your fractions like you have to do in math class. Essentially, he's getting half. I mean, you know that in your head, 5 out of 10 is half. You could just take it and divide it by 2, or convert it to a percentage and just say he gets 50%. You know, however you want to do it. No, you don't have to. You don't have to reduce fractions in here. I don't care. Just make sure you're using the correct one. Okay. All right. So we're selling the assets. So what is our sales price? They tell us they were sold for 10. That is not going to look very good. How much did they have in the assets?
64,000.
64,000 is their cost. So they lost their tail on this one. So what is their loss?
54,000.
I'm inconsistently using minuses and parentheses. They're the same thing though. All right, so we have a loss of 54,000. So we need to determine who's going to get what portion of that loss added or subtracted from their capital account. All right, so your allocation to Farley is 5/10. So how much is that?
27.
20, is it 27 even? Yeah. So one of these has got a 5 in it. All right, so 27,000 goes to Farley. What about Green?
16.
Green is going to get 16 too, and Hall is going to get the rest of it, which is 10,008. You should be able to add these up and come up with 54. Is that making sense to y'all? Okay. Now, the next step in the process is to pay the liabilities using cash from the books plus cash received from the sale. So how much cash did they have before they started?
11,000.
What was it? 11? Okay. 11,000. I thought I heard 20. I was like, but these examples are so close together. All right, how much did they get when they sold the assets?
10,000.
10,000. All right, so how much cash do they have now? 21,000. They have $21,000 to use to pay off their debts, and their debts are how much?
9,000.
9,000. So we'll subtract that from our 21, and that leaves us with 12,000 in cash. So we're going to split that 12,000 amongst our partners. All right, so let's figure out, after all that whole process, how much capital does each partner have? So when we started out, they each had 22. So we'll put 22 in here. Okay. Now we have to reduce their capital accounts for the amount of the loss that they received allocation for. So how much did Farley get?
6.
How much?
27.
Okay. So he got 27 allocated to him or her, whatever. How much for Green?
16.
So 16.2 of that loss went to Green, and then 10.8? 10.8 went to Hall. Okay, so let's see what their capital looks like after we reduce it for this allocation. What does Farley have?
Negative 5,000.
Negative 5,000. That's not good. That means there's a deficit or a deficiency. How much does Green have?
5,800.
Green has 5,800, and Hall has
11,200.
11.2. Okay. So there's two ways this could go. Technically, Farley, because he's got a deficit, should put $5,000 of his own money into the partnership to zero that out, because he's in the hole. What if he doesn't have it? Then he ain't gonna put it in there. If he hadn't got the money, then that 5,000 is gonna have to be, they're gonna have to eat it. So in this problem, we are assuming that he can pay it. So we will put a plus here showing, this is the way the entry would look. If he was putting $5,000 of cash into the business, we're going to debit cash and credit his capital account, right? So you're not seeing the cash piece of this, but just remember it would be a debit to cash, because we're just showing capital balances here. And then we'll credit, what's his name? Farley Capital. Because when I was, I guess it was a year or two ago when I was working up these problems, I was thinking, no, wait a minute. You put a plus, I'm thinking everything's got to have two sides. So I'm thinking you put the plus there, where does the other part go? It's cash. Okay, so that's not going to change their capital accounts. It's changing cash and Farley's capital. Okay, does that make sense? Okay, so now the balance after this receipt of deficiency, Farley's at 0. That's good. And these two guys are at the same amount because that receipt of deficiency affected Farley's capital to, make up for that deficiency. And then the other part of it was cash. Okay, so let's see. We calculated that our cash was 12,000. Well, how much is this? More than 12,000, right? Okay, so we had cash of 12,000 from the previous part, and then we have the 5,000 from that receipt of deficiency. So let's see. I'll write this small enough. So now, because Farley put the money in, we have 17,000. Does that make sense? Because if it had only been 12, that would have worked had he not put the money in, because they're going to have to eat it. So adding this all the way across equals 12. But since he went ahead and made good on his deficit, they got what was in their capital accounts. Yeah.
So if say he didn't have the money to pay, would they? So they would eat his $5,000. Would it be divided with like the income sharing ratio? Okay.
So distribution of cash, he's obviously gonna get nothing. These guys will get what's in their capital account. And that will, if we were to make an entry on the books to record that, we would credit cash, debit their capital accounts, and then everything's gonna wind up being zero. That work? Okay. The next thing we're gonna do is on these last 4 pages. We're doing the same exercise, except this time we're putting it in a different format, which is the statement of partnership liquidation. So we're taking the same things we've been doing, and we're gonna put it in a format, in a statement format. Okay, so let's squish it enough where it shows up. This is landscape. Hey, what? Squishing it?
No.
Well, I mean, honestly, y'all, don't let this thing confuse you, because literally you're going down the left-hand side. That's going to be the action you're taking on each line. Okay, so let that be your steps that, you know, we did this, we did this, we did this, we did this. And you should be fine. All right, so prior to liquidation, Sanders and White have capital balances of 70 and 115. The partnership had no cash. So they were left with no cash except for what they get from selling assets. So they sold the assets for $375, and the liabilities of the partnership were $55. So this is all pieces we need to do this. Okay, so Sanders and White share income and losses equally. Hallelujah. And what they want us to do is figure out how much cash was received by each partner as a final distribution. We're going to prepare this statement of partnership liquidation to figure that out. This is our method of figuring that out. On your homework, you may have all this information, and it may say, how much did Sanders receive as a distribution of capital? Okay, well, that's going to be your final answer at the bottom, or the next to last line. How much cash did they get? Would you end up with risk capital? All right. So you can use this format to answer your homework questions. Balances before realization. What about cash?
No cash.
No cash. That's what they said. There was no cash except what they got from selling assets. All right, first of all, I went through this with the other class. All right. Remember our accounting equation. Assets equals liabilities plus owner's equity for capital. And you remember that the combination of this side has to equal that side, right? Y'all remember that vaguely? It's like the foundation of accounting. Okay, so keep this in mind. Okay. How much do we have for liabilities? What they tell us? $55,000. They didn't give us anything for non-cash assets. How much does each partner have? That's right. Now, they sold non-cash assets, so we know they're bound to have some. If I draw this little line here, this is assets plus liabilities plus owner's equity. So remember your accounting equation, assets equal liabilities plus owner's equity. So if you had to figure out how much you had in non-cash assets, how would you do that?
Subtract. Oh, you know, you just add.
You just add those capital amounts up. And the liabilities, capital and liabilities. So how much do I have in non-cash assets?
240.
Okay, y'all see? So to check yourself, as you go through each line, just make sure that this side in total is the same amount as that side in total. Okay? That work? All right, so the next line says, sale of assets and division of the loss or gain. So, for cash, how much did we sell them for? $375. So we're gonna put $375 here, because that's how much cash they got. Now, what happens to those assets when we sell them? We're getting rid of them, right? So we're gonna put a minus here. Now, if we combine these two numbers, what are we gonna get? If you take sales price minus cost, what does it give you? I mean, yeah, I want the number too, but it's gonna tell us the amount of the gain or loss, right?
Yeah.
Yeah. Are y'all with me or are y'all just getting bored? You can be honest, it's boring. All right, so think about this. Our sales price. It's all right. I told y'all bring snacks if you need to. This class is a hard time. Sales price, $375. Cost, $240. So what is my gain? Is that right?
Yes.
I have $135,000 gain. Now, I've got to distribute, that looks like an 8, doesn't it? Really? I've got to allocate or distribute this gain to each of the partners. How am I doing that? It's equal, right? So we're just going to divide it by 2. And that gives me what?
67.5.
All right, so 67.5 each. So I'm going to put that, because remember, each line's got to work. So if I just left this, then I'm going to be off. I've got to put, there's nothing going there. We're not affecting the liabilities here. So we know the difference here is 135. We got to put something on the right. So each partner's getting 67.5. Okay. So now we need to figure out what our balances are after all this. Cash, we got 375. No more assets. They're gone. We sold them. We still have liabilities of 55. And then Sanders has 137.5. And White has 182.5. Is that right? Check my math because I don't have the answers on that. Does that work?
Yeah.
Okay. Okay, so if you're doing this like we did the steps, step 1 is to sell the assets. Step 2 is to divide the gain. So this line here is 1 and 2. Steps 1 and 2. Step 3 is to pay the liabilities. So now we're going to look at the liabilities. How much are we going to have to use of cash to pay our liabilities?
55,000.
55. So we'll show that we're paying these. They're going to go away. And we'll show a reduction in cash on the other side to take care of them. So that leaves us with 325 in cash.
Sure, 20.
20, sorry. I haven't seen if y'all are awake. Nothing in non-cash. We sold them already. Now we've got nothing in liabilities. Well, this transaction affected liabilities and cash. So we're not doing anything here with capital. We're just going to bring the balance down. What affects capital is allocating that gain or loss, and if there's something we have to do with that deficiency. All right, the next line is receipts of deficiency, if applicable. Well, you're not going to have it in every problem. The line's just there in case you need it. So, I mean, that's just nothing all the way across, and you can bring your balances down. So how much cash is each partner getting?
137.5 and 182.5.
They're going to get what's in their capital account because your ultimate goal is to wind up with 0. And those two amounts should add up to 320. 137.5 and 182.5 should equal 320. If they don't, you have a problem. Something went wrong somewhere. But even if you don't remember anything else, you're gonna have one of these on the test. If you don't remember anything else and you just did zeros across the bottom, I mean, that's worse, huh? At least you know you're supposed to end up with zeros, right? At least you got the concept of we're liquidating the business and we should end up with nothing. So, I mean, it counts. So, I mean, if you get stuck or you forget, then just enter what you know. All right. The next thing on here was to prepare the journal entries. I'm not putting that on the test. I had it as a bonus, which I've got 110 points built in, so I'm not going to worry about it. So I'm going to skip that. Let's go to this last one. This is going to be a situation where you have a partner who's got a deficiency. And what do we do with it?
So,
Pretty much. Your capital account is negative. It's not good. Okay. So in this one, you got Harold and Andy. Here's their capital balances. Here's the sales price of the assets. No cash and no liabilities. So this is pretty easy. All right. In this one, though, Andy is unable to take care of his deficiency. We already know he's going to have one. All right. So we had 0 cash, 0 liabilities. Harold had 138. I changed his name on this problem. I had him on here as Homer, and everybody thought that was so funny. Homer. You know, I was thinking of that Home Depot, the Homer bucket. Those orange buckets, they call them Homer buckets.
It's like Homer Simpson.
yeah.
Yeah. I think I don't know why I came up. Sometimes I'll make these problems up and just trying to pull random names out of the air. Sometimes I try to make them funny just to break up the monotony. But, okay, so we've got the capital amounts. We know we're going to sell some assets. So what's the cost of the assets? They didn't give us that. 50? What's this amount?
218.
218? Just add your capital together. Because remember, you've got two sides of this equation, and the total of this side should match the total of that side. Oh, gotcha. Okay. All right. So that's the next thing. Sale of the assets. That's going to add cash of 50. And that's going to make our non-cash assets amount go away. So sales price of 50. Cost of 218. That's a big loss. How much loss do we have?
168.
168. I mean, either their stuff wasn't worth anything, or it was unique, or they were trying to get out fast. All right, so how are we splitting this up? Equally. So if we divide this by 2, what do we get?
84.
$84,000 of loss to each partner. And we're going to do that on the same line. This line shows the sale of the assets and divide up this gain and loss. So each one of these guys is going to absorb $84,000. And like I said, as soon as you're writing it down, you can tell if you got a problem or not. So now Harold has 54. And Andy has -4. So there's nothing in liabilities. We got 50,000 left in cash. So that's kind of easy to spot check the math. 54 minus 4 is 50, and then you have 50 on the other side. So we're complete. Payment of liabilities, there's nothing to do. We didn't have any, which is odd. So we're left with 50 in cash. That nothing changed because of that. We're just bringing the balances down. Okay, receipt of deficiency. Well, he can't pay. So we're not gonna put anything in cash. But we do have to zero it out, right? So we're gonna move his negative amount over to Harold. And those two will wash each other out. So you've got Harold now with 50,000 in his capital account. He'll get that 50. He'll get nothing. And at the end of the day, everybody's at zero. That makes sense? Now. So I have given y'all chapter 12 worksheets. Yes?
You have.
Okay. I gave you your practice problems. If you don't have them, pick up a copy. I'm done. If you want to sit in here and work on your practice problems, see if you need help, that's fine. If you want to take them and roll, the answers are in the Canvas module for this week. So you can work through them and see how you did. Check yourself, make sure you're getting the right answers. You've got a quiz to do for the test. You've got homework on this. So don't pedal around and wait till the last night to tackle this stuff because you've got a few things to do. All right, there's 10 true false. 11 through 34, so 24, 25, multiple choice. 7, matching. And it's terminology. What's deficiency? What's realization? What's proprietorship, partnership? Y'all should know this stuff. What's mutual agency? Liquidation, income sharing ratio. And then you're going to have 2 problems, 3 problems to do where you have journal entries to make. You're going to have one where you have the income allocation based on salary and interest and then remaining. And then you'll have one like we just did.
That's, okay.
So it's kind of, the true false ones are easy. I mean, I don't like tricky true false. So if I thought it was remotely tricky, I left it off. You have true false in your quiz. So you'll have the practice. And I want to say I gave you unlimited attempts on that quiz, but the highest score will count. So take it as many times as you want to. The highest score will keep. You got your practice problems. That should prepare you. You may bring a memory aid. You must bring a calculator and a pencil. Not your phone. Bring a calculator. Any questions? I have a couple of extra calculators, but I used to have more, so I wouldn't rely on me. Plus, they're not the best, so I mean, you kind of have to wrestle with them to make sure you push off the keys. So make sure you have your stuff, children. All right, so you can go, you can stay, up to you. I kind of knew where that was going. It's fine. I mean, it's up to you. You're grown-ups. You manage your own time. All right. Y'all let me know if you need any help with anything. That's fine. Just let me know. Oh, I got to stop this recording. Stop.